So Brad is one of these guys that he doesn't speak at all. So you have to really work him to speak. But his story is it's a fascinating story, and I want to get an update because you spoke. Those of you, raise your hand if you were here in Austin. So do you guys remember Brad, his speech on debt? You know, you missed out on the nut bar company. Which one was this?
Quest.
The small bar Quest. I guess it's like $1 billion brand now.
Well, sold for $1 billion, yeah.
Sold for $1 billion. But I'm gonna give you his quick backstory, and then we're gonna jump into like the update of this story. So I would say Brad is a creative capitalist that's very opportunistic, and he buys SaaS companies. And many people think you can't buy a SaaS company that's willing to pay 3, 4, 5, 6x. Okay, he gets these deals done at like 0.6x, and he buys a $5 million AR company, and he only puts up $2.5 million of his own equity, maybe even more, but then uses debt to do the rest, so he's not a lot of exposure. Then he makes back 5, 10, 15x his return from dividends for 5 years and grows the company to 15 million in ARR, and then sells it, stays on a little bit, and that's sort of where the story, I think you had left. They invited you back in September. Fill in any gaps in the story and then pick us up. Where's the company at today?
Well, the company 2 years later is half its size. It was at the time when I sold it doing 20 million in revenue and 6 in profit, and I believe it's like 12 and 2, something along those lines.
And so for the folks that missed you in September, what quickly happened? And then I want to talk about buying in the future.
Well, there was a litany of things that happened, but one of the things that happened is, and like many of the companies here are super efficient, and many people wear many hats, and the company kind of went from an entrepreneurial company to we need more people to do the same amount of work, so the payroll skyrocketed.
Who was the buyer?
It was a New York-based private equity fund called TZP.
Raise your hand if you're here with TZP. All right, so what'd they fuck up?
Well, when they hired the consultants to do their due diligence, one of the things that came back on me was I felt I was a little too fast and loose and not structured enough. But there was a 10-year history of increasing revenue and profits. So you can, to listen to consultants tell you Brad Miller isn't structured enough, that may be true, but when you have a 10-year history of raising revenue and profits, it works.
Structure. Yeah. Just to be clear, they were challenging the fact that you were spending $300,000 to $500,000 per month on ads.
They weren't just challenging that. They were just really challenging the fact that there wasn't an organized structure. It was like Brad and his helpers, and where was the game plan written down? Where was this documented? Yeah. But after 10 years of working with the same people, you don't necessarily have to document things. So they were a little, they wanted to hire more professional management, and the company proceeded to crash. In part because they, on the cost side, raised the cost significantly, and on the sales side, our sales were heavily driven by pay-per-click, and they decided that was not important, and so they outsourced it to an agency. This is something that I used to spend a fair amount of time working on with somebody, because that's how we made our money. Yep. It was like being a day trader and outsourcing the day trading. And so their returns on the advertising went from what they were to half of what they used to be.
So what was your return on it? What year did you buy it again?
2010.
And so for every dollar you put in, how much did you make 5, 10 years later? 3 years later?
Well, so here's how we looked at it. We looked at it a little different. It's a reasonable question, but we looked at it as we had an immediate sale, and if we could make it, if we spent $1, can make $1, then we knew that all renewals were profit after that. So we didn't have to invest any money. If we could spend $1, make $1 right away, we were even, and then any renewals or upsells thereafter were just gravy, and that's how we operated. And so.
But you took, just for context, because this is important, I mean, he was taking $1.5 million in dividends in your best year, I think, right? 2018?
Best year was 6, actually.
Oh, 2006?
No, 6 million.
Oh, 6 million.
Yeah.
Oh.
Yeah. Yeah. But it started at $1 million and it increased.
I'm rarely speechless. This is great. Okay, so
Well, when you're making $6 million, right, you can go to the bank and say, give me 1x my profit, and then,
as debt. Yeah, I mean, I think you're a genius at this. So my goal in the next 14, 15 minutes is to pull some of this stuff out of you so that current operating SaaS owners that want to go buy someone in their space for 0.5x using debt can sort of have a playbook. The first thing is finding the deal, right? You're not going to find your deal reading TechCrunch articles about people that just raised it too high valuation, because then you got to go negotiate with a VC that wants a 30x multiple. So what is your advice for finding someone willing to sell for under 1x?
That's not easy advice, my friend. No, it's, network a lot.
Oh, no. Tell them how you did it, because then they can think how to use that.
Well, I had a previous internet security company where we bought a lot of companies, and I sold that business to Goldman, and I wanted to keep buying more businesses. They didn't want to, so I left and took the money that I got from selling it to Goldman and went and bought the next company that I would have bought for them, as part of my previous company, but they didn't want to go in that direction. So I thought it was a good deal, and so I went in it myself. The company was like, in a lot of cases, sometimes these are just orphan companies where the founders have done some things very well and some things very badly. And in this particular case, they created a good product. They had a very bizarre, and it was an internet security product that was a cloud-based product, a SaaS-based product, but they had a perpetual sales model, meaning you sold the product for $1 and then that's it, and there were no renewals. And but you continued to provide hosting. It wasn't like you were buying a piece of software and downloading it onto a device. You still had to log in like any other SaaS product. So why they had this bizarre business model?
So there's a takeaway for you guys, right? So look in your space at somebody selling something one time. Like, this is a great way to go build a lead list of things to go buy. Look at your space and go find something. That's effectively what you did. We're gonna make it recurring. So that's step one. Step two, you are really close to, I think it was a VC firm or a PE firm that you knew wanted to get rid of it.
Sure.
Is that true?
Well, it was an investment bank that was selling it. So.
Okay.
And they approached me because I had a history of buying similar companies, and I wasn't, and they've known me as someone who's willing to buy complicated situations, and this was one of those complicated situations, in part because of the problem of not making it a SaaS. It was a SaaS product without a SaaS business model. Yep. So the first thing we did is we turned it into we made it a subscription model, and the revenue increased 40% overnight.
And you bought it for was it 1x? What was it doing revenue-wise when you bought it?
It's doing $5 or $6 million, and we bought it for about $5 or $6 million. And
how much cash did you put up though?
We put up 5.5 of equity and $1 million of debt.
Okay.
And the business was losing money day one, but because of the renewals within a year, it went from losing $1 million to making $1 million, literally overnight, just by that one element. And then we just continued. We bought more businesses at good prices and kept adding to the revenue line, and we got a lot more leverage. We only needed one CEO, one CFO, and so you add revenue to that machine, and more of it falls to the bottom line. And
so tactic one there would be, again, look for folks selling a one-time thing in your space. Tactic two would be pull a power move, and VCs are emailing you asking to invest. You can write back and say, we're very well capitalized. If you have any underperforming companies you'd like to get rid of, I'd be happy to take it off your hands. That would be a great reply email there in an appropriate way. A lot of these folks sometimes want to take the write down, especially after the firm has a big exit because of the tax coverage. So they don't mind the write down occasionally. And if are any VCs in the room that can speak more about, Simran's not going to raise his hand. I know we have some VCs. We have our investors in the room, which we love. But people, Simran, investors love write downs, right? They love a tax shelter, right? A legal tax shelter, right? Legal tax shelter, just confirming. But these are good things. And then step three, Brad, there's all kinds of, I've seen folks in this room buy companies for really cheap where they'll go on a marketplace like the Google Chrome store. They'll see that a Chrome extension has 500,000 downloads, but there's a thing that says when the developers push the last update. And if it's more than a year ago, it's probably sitting there doing nothing. You buy that for cheap. It's a 500,000 email list. So my question to you is, now that you guys have those three ideas, this company which you love and you know very well is now on the decline. We're in a bad economy. I'm waiting for the news to come out that you buy it for $1.
Probably. I actually bought another business.
Oh, okay. Tell us about this.
It's a prop tech business. Bootstrap founder. It's an app that the property manager provides to the renters of a high-class building to do all the business operations. So if you want to pay your rent, you want to book a work order, you want to go to a yoga class, you do it all through the app.
When did you close the transaction?
I closed it in mid 21, so just about a year and a half, or almost 2 years ago.
And what was the revenue of this company when you bought it?
It was doing about $3 million. I bought it at a $6 million pre-money value.
Oh, you're up on the 2x is a big deal for you.
It was. That one worked. So he was, breaking even, very bootstrapped, was all in Chicago, had 100 buildings in Chicago, and all the other competitors had raised $20 to $80 million, and they were all based in Chicago too. But he had the #1 market share, and I'm like, how is that possible that in their backyard you're kicking their ass?
How do you do it?
I'll tell you in a second, but the deal was, let's go take the show on the road. And so the money I invested actually went to him personally, because he was starting to make profit, and he was like, do I reinvest the money? Do I go buy myself a new car? And I was like, okay, here's this money. It goes in your pocket. We're just going to reinvest everything into the business.
The $2 million ARR, $4 million cash. He took all $4 million off the table. $3 million cash.
Yeah. So I bought 51% for $3 million.
Ah, okay.
And now the business is doing $7 million.
A year later.
Yeah.
It just came from, why couldn't he think to sell outside of Chicago?
It's not that he couldn't sell it, it's just that he was just looking at the cash, and like the business was starting to make $30,000-$40,000 a month, and he was like, and he wanted to, spend it, and
Yeah.
And so
Which one would do with money?
yeah, and so I think it was a conflicting thing for him, and so I took away the conflict.
Jamie, what are you curious about? You got a question for Brad?
I was wondering what you did with the perpetual license customers.
What did you do on Awareness Tech to the people that were on perpetual licenses? Did you force them into a new recurring fee, or did you grandfather them?
We did not grandfather them.
Ruthless.
We did.
How did you do that copy-wise, though? Was there any blowback? Did they go post negative reviews on G2? How did you manage that?
So software kind of gets extinct, right? I mean, you have to keep up with it, and so if you wanted to keep up with it, then we were like, if you wanted to get the latest version that worked with all the latest other software so that it is functioning. But we gave them notice, and it was tricky for sure. But honestly, we didn't get that much pushback, and most of that business was dealing with consumers, not it wasn't B2B. On the B2B side, which was a small piece of the business, they were doing it on a subscription basis, but for consumers, they were doing it as a one-off basis.
Interesting.
And it was a bizarre model, and there was nothing super clear in the terms of service that said that you could have it forever. It wasn't super straightforward.
Top 3 terms, if these guys are looking at raising debt, I'm talking traditional, so I'm not asking for a founder about that. So the way you raise debt, what are the top 3 terms they should all be negotiating?
Well, it depends what kind of debt it is, right? I mean, so it's funny. Someone mentioned Silicon Valley for obvious reasons. They were one of our banks, but they never lent us money. We flowed all our credit cards through them, and they would come to us all the time and ask if we wanted to borrow money from them. We'd say sure, and we were the only company they had that was making money. And they'd say, but who's your named VC and when was your last raise? I'm like, well, here's the thing. We don't need that because we make money, so we don't have to fund our losses with a VC.
Hello.
And they would say, well, we need to have a VC. I go, so you want me to lose money and raise money to cover the losses, and then you'll lend me money? And they're like, yes. I'm like, that's the most backward thing I've ever heard, but that was their business model. So we could never get a deal done with Silicon Valley, though they were a bank of ours and saw the cash flow flowing in every day, and just couldn't get their arms around it. So that was one thing that didn't work. But we had both traditional bank debt and mezzanine debt.
But name the terms. So should they negotiate for low warrants? What financial covenant is a gotcha?
So the basic bank debt was very plain vanilla. There were no warrants. It was purely a multiple of EBITDA, typically 2 to 3 times, depending.
So do they all have to be making EBITDA in order to go raise bank debt?
Yeah. So that's the difference with your debt is you don't do that. You don't need that, right? You're kind of a form of equity in a sense. But we were making profits, so our rates were probably lower than what you charge, but we were making profits versus your typical customers.
We're not cheap, but we don't take equity. But okay, so but what are some other? What's the biggest financial covenant gotcha that they should all negotiate out of?
Well, that stuff. I mean, we were taking dividends, and so we were always really good on the debt to EBITDA. We were always good on interest EBITDA coverage. Where we always struggled was the fixed charge because it included the dividends. And so we would take out a dividend for the year, but we had to live with that coverage.
Yeah.
And so we were always trying to balance it. What's the maximum we can take and not have any hiccups for the year and not blow through that.
You just write that down. Fixed charge coverage ratio is what I was referring to. If you want to go down that rabbit hole, fixed charge coverage ratio. What are some other ratios that were challenging to manage with debt?
Well, listen, debt to EBITDA is the main one that they probably care about, right? I mean, so that's the main one. But that's kind of standard in the traditional bank universe. And with the mezzanine debt, which we also used, one of my partners was in the mezzanine debt business, and so.
How expensive was the mezz slice?
That was typically 10 to 12% coupon with a PIK. So with a kicker, which could either be in the form of a PIK, an accreting PIK, or it could be in the form of warrants. But
so when you were evaluating it, there's the cover rate of 12%, but then there's the warrants, the PIK. How did you guys actually model in your pro forma the true cost of the mezz slice all in?
Well, for the most part, they preferred to do it as a PIK, so they were guaranteed their 18% all-in number.
Okay.
But we did in the early days when we had less leverage, that's what we had to deal with, and then in the later days when we had more leverage, we got it to do it on an EBITDA. On a you get an equity warrant, if you will.
Mm-hmm.
They weren't super complicated. Honestly, it was pretty straightforward. Not as straightforward as your debt. Yours is super easy.
I know,
our biggest thing that I hated the most was the legal fees. You had to pay for not only your lawyer, but their lawyer, and their lawyer had no incentive to keep the fees down. And when you're not raising a lot of money, we were talking about $1 million, $2 million, $3 million, you'd get these crazy legal bills. That's probably what drove me the most insane.
Yeah. I want to have you wrap up talking about how the buyer, if the debt you had on your books impacted your ability to sell at the end, but then I'll throw it over to the audience for one last question. So tell us that. M&A
it did
process.
not.
It did not, okay.
It did not at all. They just viewed it as an enterprise value, and whether they wrote the check to me or the bank didn't matter to them at all. And in fact, the bank ended up re-upping. And whereas, it was a local bank in Connecticut called Webster Bank, which still was a large bank. And when I went and asked them for $10 million, they laughed at me. But when the new buyer, they could get comfortable with 5 or 6. But when the new buyer came in and said we want $10 million, they had no problem. And I'm like, how is this possible? Same business, but
some big sponsor with some big fund.
Yep.
Yeah.
Yep.
All right, raise your hand. Who's got a question? Any question? Okay, Susan or Bridget. Sorry. Why didn't the private
after the fact?
Let me repeat it because everyone can't hear. Why did the private? Oh, go ahead. Finish. Susan, you get.
Yeah. Oh, gap earnings. Right. They changed it back. Yes. Yeah.
So why didn't the summary is why didn't the private equity firm listen to Brad?
Have you? No, I think she's saying after they realized they were wrong, why didn't they come crawling back, right? Do you know many private equity people? I can guarantee you that was the last thing. They would rather burn in hell, hanging by their ankles, than they would come back and say, "I screwed up." Masters of the universe, yeah.
We got time for one more. Calvin, you want to throw one at Brad? Any questions? Simplera's not going to go raise a bunch of debt and buy a bunch of companies. We might. All right, we'll go in the back. Go ahead. What do you got?
Well, I don't know if I heard the numbers right. You said it was 5 million equity and 1 million in debt for this.
Initially, when we bought it, yeah.
But I guess my question was why you did the debt? I mean, why not just all equity at that point?
Well, because I wanted to write less of an equity check. I was trying to figure out, like anything else, when you buy a house, how much can I borrow, and then I'll fill in the gap, right? And so this company was losing money, so the bank wasn't interested in giving us a big debt check, so they were comfortable giving us $1 million, even though it was losing money. And so we had to fill in the rest, which was another $5 million.
We're out of time. Last question, quick. Rajesh, hit me. You should be the next Mark Leonard. Why not create the next constellation?
I don't like working that hard.
On that note, give it up for Brad Miller. That was great. Thank you. I'll follow you off.